Good morning. Good morning to everyone. Welcome to our presentation for 4Q 2019. As always, we'll have our CEO, José Sevilla, explaining the highlights of quarter, and then Leopoldo Alvear will get into detail with our results. Now we'll have a Q&A session, and we'll give the floor to the analysts interested in asking questions. So without further ado, I'll give the floor to Pepe. Thank you very much, Íñigo. Good morning. Let's start with our presentation. As always, there's going to be an introduction, and then Leo will get into detail and will explain what happened in the last quarter. Let's summarize what's happened for us in this 2019 year. We have a good overview here on this page. Our year goals were focused on continuing with our goals set in our strategic plan, fostering commercial activity after 2018 with the integration of BMN, achieving cost synergies that we had set for ourselves when we integrated BMN, the increase of quality of assets, the accelerated reduction of NPAs, and as you can see here, to continue to generate capital organically throughout the year. In these four aspects, we're happy with what we have achieved. Regarding commercial activity, this slide, we show it every quarter, the performance of customer satisfaction. To your left, you can see internal surveys. We perform them every year, and this perceived quality of customers was deteriorated slightly in 2018 as a result of the integration process. Well, it had been recovered to levels before the integration, and in the second year half has increased again. To your right, where you're familiar with this graph too, it shows commercial intensity performed by an external consulting company. As you can see, in 2019, we've increased again these results, and we are ranking first in terms of commercial activity. More customer quality and more customers. It was another one of our goals in our plan to increase our customer base, and as you can see at the bottom to your left, increasing customers with direct income deposits. Payrolls. We've increased that number this past year, and also digitalization indicators in our customers. Another goal we set for ourselves, the number of digital customers this past year has increased 13 basis points. We've reached 53.3%. The goal in our plan was 75% next year, and we're going to be close, but we think we're going to be close at 75%. Also, digital sales, you can see their development. They've increased 20 percentage points to the past 2 years. We've reached the goal we set for ourselves in the strategic plan, a percentage of digital sales over 35%. Let's speak about the digital world. Here we have the assessments of our digital channels, the app, the online world for retail customers and for companies, for business. Surveys performed amongst our customers. We can see how the quality perception in our channels has increased, and at the bottom part of the slide you see external sources, and there you can see how, based on Documetrics, which is an external provider for rating digital channels of financial institutions, we rank second in all the graphs. Here, I have to say that peer 1, 2, and 3 are not always the same one. They change from one table to another. We have online channels. We feel comfortable with them. We're happy with them, and they fare nicely with any of our competitors in each of the alternatives. Throughout the year, we have improved, as you can see on the slide, regarding the launching of new products and services. Bankia Gestión Experta Online, this specialized channel for self-employed, digital mortgage, Hipotecaon, and also the real estate valuators. And one of the successes of 2019 is in this slide. We've grown in mutual funds, and our growth has been different compared to our customers, to our competitors. We've been leaders. We've received 22% of the total new production in the sector, and to your right you see an increase of almost 17% of the balances of our mutual funds. In this sense, you can see the market share for mutual funds in Spain. It has increased from 6.55 to 7.05%, and we're close to the goal we set for ourselves 2 years ago, which was growing 82 basis points in our market share until 7.20, and the first semester of this year will be close to 70% of market share. A very good year in terms of cards invoicing and insurance invoicing, and together with mutual funds were the three elements that we called added value products that we had to foster. Cards turnover has increased almost 15% this year, over almost 13% last year. Cards turnover market share, there's an increase of 0.4 basis points, and also the card stock. This makes us closer to the goal we set for ourselves in the plan. Insurance premiums. In 2018, we had quite a flat year regarding the increase of insurance turnover in Bankia. This was highly linked to the integration of networks, but we've had a strong growth this year, over 26% in insurance premiums, and we're increasing our market share. We think that for 2020, these three lines of work, mutual funds, credit card, and insurance, are going to have a strong growth, fostered by the new commercial positioning of the bank. Let's move on to credit. Here to your left, you see the performance of credit stock throughout the year. After many years, we've had the first year in which credit has grown as a whole. Little growth, but it's still growing. The last part of the year, there was a lower increase, a bigger fall of the real estate stock as a result of the new piece of legislation that was passed related to this, which has affected the turnover. Here you can see the portfolio. There's been an increase of 3 million euro, and together with consumer finance, they've reduced the fall of the mortgage stock. Here you have the combination, the credit stock mix, and how 2019 compares to what we had set for ourselves in the strategic plan as the diversification goal of our portfolio for 2020. So I think that we will be in line with the data we mentioned for the end of 2020. Let's move on to consumer credit. We've increased our balances slightly below the goal we set for ourselves in this strategic plan, but still we're increasing our market share. As you can see at the bottom, 5.58% at the end of last year. The goal we had in our plan was reaching 6.6%. Still, it's going to be complicated, maybe in a more dynamic environment, but we think that 2020 is going to be a year in which consumer lending is going to grow over double digit. And in 2020 we have started our activity in a joint venture we have created together with Crédit Agricole to finance consumer lending at the point of sale. Regarding companies, you can see the increase here. It's been more than 9%. We're growing at more than average rate we set for ourselves in the strategic plan, which was plus 7.9%. And to the bottom, we see regarding market share, we're finishing the year at 7.75%. So we are over our goal we set for ourselves for 2020. We have to remember that here we had several lines of work in order to step up or to foster an increase in market share. The end of the bans we had in order to develop certain businesses at the end of the strategic plan, also promoting developers within these lines of works, and in general terms the commercial dynamics we've maintained throughout the year. Regarding mortgages, as you can see, new lending, new mortgages, we've had a similar invoicing compared to the previous year. This is in line with the sector. With November data, we see that this sector repeats the same figures regarding mortgages in 2019. A year, as I've said before, with an impact from the new mortgage law. At some point, it has slowed down the signing of transactions in the second half of the year, and here it's complicated to assess to what extent there could be a lower credit demand regarding mortgages. To your right, you can see the basic indicators, which are very similar. We invoice almost a third of mortgages to new customers, almost the half of them fixed rate mortgages, and LTV is conservative, 64%. And regarding finance, since 1919, all of this is under sustainable financing. To your left, you have some important milestones that have taken place last year regarding the commitment of the bank with sustainability and climate change, and our commercial offering. Since before the summer we created a business unit focused in sustainable financing. We're adapting our credit policies and granting policies to the environment of sustainability that we want to foster. Regarding the second point, cost synergies, I'm not going to insist on this because I think you're familiar with this. Operating expenses, they have fallen 2.5% throughout the year. They will get into detail later on. This means that cost synergies compared to the natural evolution of expenses is at 120 million euro cost synergies, which means more than 50% of the old cost base of BMN. Asset quality. Here you see the performance throughout the year. The NPAs, non-performing assets, there's a figure that's repeated several times, which is 8.4 billion. We've reduced to half the balance of non-performing assets. So from 16.8 to 8.4, 8.4 billion, the reduction of total NPAs. You have to remember that in the strategic plan, we had set for ourselves a reduction goal of 8.9 billion, and we're there. We've barely covered 94% of our goal. This means that we've made an effort. We've increased the reduction of NPAs over the last quarter of the year. If you remember, the goal was about 1 billion over the years. So the last semester entailed 600 million of NPAs, and we've reduced more than 6 million this NPAs. So this has had an impact, as Leo will explain later on. But we thought it was a good idea to take advantage of this at reducing NPAs in 2019, although this entailed some additional costs in our annual accounts. The gross NPAs ratio is 6.4, close to 6%, that we had set for ourselves 2 years ago for 2020, the strategic plan, and the net NPA ratio is at 3.3%, again close to our goal of 3%. So the P&L, I would like to highlight the closing of core result. You have to remember that at the beginning of the year, the growth was 5%, which meant that our goal in terms of core was 1.3 billion euro. In the last meetings, we said that we were going to be a bit between and 15 million below this goal of 1.3 billion. The final closure was 1.287 billion. As you can see, the net interest income equals the increase of fees and commissions, and a big part of the improvement of the core result this year is focused on lower operating expenses. On the other hand, the performance of our profit before taxes, it had this improvement in the core result, 47 million, and the net trading income falls from a high figure in 2018 in the increase of provisions, the lower part of P&L. Later on we will get into detail. This was caused this fall of 17.5% of profit before taxes, which leads us to a net result of 541 million euro. We've increased 16 basis points of CET1 of capital. CET1 fully loaded closes at 13.02%, which means an increase over that minimum we have set for ourselves of 12%. And as you can see in that square to your right, our goal is distributing the excess capital over 12% of CET1. In order to finish this part, the dividend, the decision taken by the board is to maintain the dividend per share approximately in million euro, about 355 million euro. Therefore, between 2018 and 2019, we'll be distributing 709 million euro in dividends, which entails a payout of 75% for this year, compatible with the increase of the capital base or the capital ratio in 73 basis points, as I've mentioned before. And I'll give the floor to Leo so that he comments on the second part. Thank you, Pepe. Good morning to all of you. Let's start by going over our P&L. You have the comparison between 2018 and 2019. As you can see, as Pepe said, the net interest income has been reduced 0.7%, balanced by the increase of fee and commission, the same amount. We have a lower net trading income as a consequence of the fact that in 2018 we had an important turnover of the same, and this leads us to a gross income that, excluding ROF, would be flat, as we'll see later on. Operating expenses, they behaved better than expected as a consequence of the increase of synergies up to 220 minutes versus 190 that we expected initially. This entails a reduction of 2.3% in OPEX, and expenses plus net interest income and fee and commission lead us to a core result of 47 million euro. In the lower part of the P&L, we have the performance of provisions, and as Pepe has explained before, as we'll see later on, we've had a great impulse in the reduction of NPAs over the fourth quarter, which means provisions that we expect have been an effort this year and will not repeat it in 2020. And with all this, we have this result of 541 million euro. The difference with 2018 is based on the reduction of ROF, net trading income, and the extraordinary provisions in order to reduce the NPAs in Q4. Let's go over the performance of net interest income. To your left, you see Euribor performance in gray. You have Euribor according to forward curve of November 2018. Based on that, we planned the budget for 2019. And at the bottom, the green curve, you see the performance of the real one and the forward one. The curve has now for the rest of 2020. The first part of 2019, Euribor was around minus 12, 13 basis points. It was reasonably similar to what forward curve was telling us. But the second part of the year, the average was around 31 negative basis points, and we saw a difference compared to what we expected. The average in 2019 was around 21 basis points, and the average we have for 2020, according to the current curve, is around minus 25 basis points. Even though the Euribor has had a bad performance, we've managed to partially balance this performance with good commercial dynamics, maintaining performing credit as stable, even positive, and the mix of our production. We're focusing in consumer finance and companies with a high yield, and therefore improve the total mix of our back book. However, we had a negative impact as a consequence of a lower contribution of our portfolios, because we ended 2019 with 2.4 billion in portfolio, less compared to 2018, and we had a higher excess of liquidity, and the cost we have to assume for the same. The cost of customers is stable around the gross customer margin is around 1.64%, stable. For 2020, we expect 4 in net interest income as a consequence of the performance of the Euribor I've mentioned before. That will be higher in the first part of the year, which because we are repricing against mortgages at 0.12 compared to 0.25 of negative Euribor, and we have 2.5 billion euro in portfolios that are due this year. We need to see whether we have an asset where we can reinvest under our philosophy or not investing in assets with high risk. We'll continue to take a look at sovereigns, and more particularly the Spanish one. Let's move on to fees and commissions. They've increased 1.2% over the year, but as we've said in 2019, some of the fees and commissions are not comparable between 2018 and 2019. When we take out these fees and commissions from 2018 that came from management fees and commissions from BM and customers before applying the commercial position of Bankia, and other provisions that we charge for selling write-offs of BVA that are not existing anymore, we see that comparable commissions, fees and commissions, have increased 5.6%. And you can see to your right, this increase in the fees and commissions has been higher in the second part of the year. Second semester, fees and commissions have increased 6.7%. This increase is the result of the good commercial positioning that Pepe has explained, the increases we've had in performing credit, and all the increases we've had in assets outside the balance, mutual funds, pension plans, and insurances that have increased almost 5%. Additionally, we expect that in 2020, as a consequence of the new commercial positioning we're implementing, that will be up and running at the end of February, we'll have an additional increase of provisions. So for 2020, we think that we should have provisions that throughout the 12 months will increase double-digit compared to 2018. However, it will be after Q2, when we start to see this increase of fees and commissions as a result of this new positioning, because this is going to be applied since the end of February. As you can see, the recurring gross margin, as I've mentioned before, is stable. The reduction of the net interest income is set off with increase of fees and balance and commissions. In OPEX, we've reduced them because of the synergies that Pepe has mentioned before. We've ended up having those synergies in 2019. We see that we compare Q4 against the same period in the previous year. The reduction of expenses is 4.3%. Have we maintained our competitive advantage compared to our peers, because our APR expenses are less than our peers to September. We expect a reduction of expenses because we've finished extracting all the synergies from our transaction with BMN. Let's go through our core result. And as we've seen in other quarters, it continues quarter after quarter. 2.8 billion euro a year, 3.8% of increase compared to 2018. As you can see, Q4 in 2019, we've had a positive result because of the synergies from BMN. The guidance we have for 2020 is maintaining a stable core result. We'll see a decrease of the net interest income and an increase in fees and commissions over around double digit and a reduction in expenses around 2%. Let's take a look at the lower part of the P&L. We wanted to differentiate between the organic part, the performance of the quality of our assets, and the part which is a consequence of the acceleration in the reduction of NPAs. Let's take a look at the organic part. The risk cost, the cost of risk has been 26 basis points. If we add 2018 and 2019, we're in line with the 24 basis points we set for ourselves for the strategic plan period. And you see that the gross NPL entries and the net NPL entries, gross less recoveries and foreclosed assets, among other things, are reasonably in line throughout the quarters. We're not seeing a change in cycle. We are not seeing a reduction in the quality of assets. And as you can see on the slide, we expect that for 2020, we maintain this organic cost of risk around 20 and 25 basis points. And the deviation or the variation between being in the lower upper part of the rank will come from the recoveries level we have, particularly in lending to companies. But as I've mentioned before, what we are seeing regarding cost of risk, organic cost of risk, is not different from what we've seen in previous quarters. Let's take a look at the P&L, the bottom part, the provisions of the year, more particularly Q4. There's been an important acceleration in the reduction of NPAs. In Q3, we presented the results and we said that we wanted to reduce NPAs around 500 or 600 million. The reality is that we have reduced 1.25 billion euro this quarter. It was 1.4 billion up to September, and we've added more in the Q4 as a result of the sales of NPAs portfolio that have had 819 million euro in the quarter. Additionally, as we've said in our breakfast with analysts in the middle of December, there's been an impact of revaluations, which has been extraordinary in our opinion, and therefore we think that since we've reached a net NPA ratio, which is what we see, the percentage of NPAs that is not covered with provision of 3.3%, when our goal was reaching 3% at the end of 2020, we don't think that we're going to have portfolio sales in 2020, since the organic recovery should take us to that 3% we have as a goal. In other words, we consider we have 150 million in the lower part of the P&L that shouldn't be recurring. They were extraordinary, a result of the acceleration in the reduction of NPAs, of this reevaluation that shouldn't take place again, and therefore we shouldn't have them in 2020. Let's take a look at the asset quality. I'll go very quickly because I've already mentioned there's a reduction of 2.5 billion euro in NPAs, 23%. So this is over what we had set for ourselves as a goal at the beginning of the year, and there's a reduction of the NPA ratio, 1.8 percentage points, 4% in gross terms. The goal in the strategic plan was 6% at the end of 2020. A reduction in the net NPL ratio to 3.3%. As I've said before, the goal is 3%, and we maintain or increase the NPA coverage around 49%, as you can see to your left. Regarding NPL, there's a reduction in the year. The NPL ratio is 5.0%, and the NPL coverage ratio is around 54%. And regarding foreclosed assets, there's a reduction of 1.9 billion euro. There's been an increase in the coverage ratio from 26 to 31%, and the mix of reduction with the portfolio sales that we had over Q4 and retail sales that we have for the exercise that are 363 million euro. Let's move on to liquidity and solvency. Our ratios are very solid in terms of liquidity. Loan-to-deposit ratio is 92%. The regulatory ratios, LCR over 200%, NSFR over 124%. Our liquid assets are more than 3.5 billion. This intermediation ratio has increased significantly in the exercise. It's now at 30.3% as a result of the good performance of the mutual funds that Pepe has explained. And last but not least, we've also increased significantly our MREL ratio. We've increased this in 3.6 percentage points until 21.9% as a result of the 3.5 billion euro of issuances, senior non-preferred and senior debt that happened during the exercise. The MREL ratio we have is 23.66%. The 1st of July 2021, so we're quite close. I estimate that with 2-3 billion of issuances, we would reach this ratio. Regarding solvency, another good year in terms of capital generation. We've generated 63 basis points in this year. Our solvency ratio is 13.02%, CET1 fully loaded, 12.85% in terms of management. Total solvency is 16.79%. We have big buffers. Our ratios compared to regulatory ratio are more than 500 basis points, and the leverage ratio is 5.4%. Although there's been a cash payout in this exercise, we've increased our capital ratio in more than 60 basis points. Pepe, you have the floor for the closing remarks. So we're beyond the 30 minutes we had set for ourselves. I go very quickly. Well, my closing remarks. I go back to the beginning. For us, it's been a year with an important commercial dynamism. We've consolidated the efficiency improvement. We've accelerated the asset quality, and we've generated capital again over 13% with an increase of 63 basis points this year. And without further ado, let's move on to the Q&A. Thank you very much. Now, we would like to have as much analysis as possible, so a maximum of 1 or 2 questions per person. Without further ado, operator, first question in the Spanish line. Thank you. Please remember that if you want to ask a question, you have to press 1 in your phone. If you want to cancel your question, please press hashtag. If you want to ask a question, press 1. And first question from Javier Echanove, Banco Santander. Please ask your question. Good morning. I wanted to ask 2 questions. The first one, I would like to know how you're doing with the current NPAs coverage and the 30% of coverage in the foreclosed assets part, considering the coverages you needed in order to carry out portfolio sales. And the second is, you've mentioned something related to guidance for costs for 2020, but I didn't understand it. do you see any possibility to have additional exercises of cost reductions based on the pressures you may have on revenues and the capital excess you have? Thank you very much. Thank you very much. Regarding NPA coverage, we feel comfortable. We're 48%, around 49%, and with that coverage ratio, I think we compare okay with the sector, and we feel reasonably comfortable. Regarding the sales carried out over the past quarter, they are due to foreclosed assets, but also NPL portfolio sales. So there's not like a coverage of one element against the other. There's not an unbalance. What happens when we sell is that we assume that there's a margin, that it's captured, that the buyer is taking, and that part of that margin, which is additional to the ones we have in our retail sales, creates this deviation of this higher cost of risk in our P&L. Regarding guidance for 2020, and please correct me, Leo, if you want, for 2020, as we've said before, we're not expecting a reduction of costs. We are working with a guidance of core result that would be equal to 280 billion euro with a reduction of with a growth of cost of 2%. We think this is going to be the speed of the increase in 2020, with 2 years of cost reduction would go back to a natural growth. This year our forecast is around 2%. Regarding the foreclosed coverage, this 31%, the one we show, is coverage since they become foreclosed assets. If we speak about the coverage from the beginning, this coverage is different. We don't have a floor, as you know, and we think that these assets, well, when you compare with other peers, these compared quite positively. So, next question. Thank you. Next question comes from José Abad, Goldman Sachs. Please ask your question. Good morning. Thank you for your presentation. I see that the guidance cost of risk, you're forecasting a decrease of cost of risks from 26 to 20-25 basis points. Could you please elaborate? Because in a context such as the current one, we clearly see a slowdown. Your own research team has a forecast of 1.5% of growth this year compared to 2% last year. What we would expect is that provisions would increase almost automatically because of an increase of expected loss. We wouldn't expect them to fall. And the second question related to this in consumer finance, could you please tell us what the cost of risk of retail customers in your portfolio, if you don't have that figure, at least the proportion of costs of credit coming from retail customers? Thank you very much. Okay, I'll explain something and you can add. If we speak about a fall, it means total sales. For 2020, there will be a lower need, also because our approach is a reduction of NPAs, but more based on our organic performance and not portfolio sales, which was the effect that you've seen in 2019. I don't know if you want to elaborate a bit more regarding the cost of risk. It is true that from a cyclical point of view, we're seeing a slowdown, but as we've mentioned previously, we think that the relevant part of the cycle regarding provisions for insolvencies is the one related to the performance of the labor market. We still think that within that 1.5% you've mentioned of economic growth, employment, as people registered with the Social Security, can grow between 250 and 300,000 in a year. We wouldn't be around the 500,000 that we've seen over the past years, but employment is still going to be created. I think we think this is positive in order not to change our estimations for the cost of risk over these 25 basis points we've included in our presentation. And then cost of consumer finance, do you have the figure? Yes, the cost of risk of consumer finance that we have, the pre-approved, which is 85% of the production we have, is around 2%, and it's been like this since we started to have this type of product like 4 or 5 years ago, so it's quite stable. Then if you include drafts and cards, the total cost is around 3%. But the consumer finance we have, which is around 85%, is around 2% and very stable. Just a comment, in the Excel file we've included data from segments where you can find these figures. Next question. Next question comes from Francisco Riquel from Alandra Equities. Please ask your question. Good morning. 2 questions. Could you please elaborate on net interest income for 2020, more particularly the headwind you expect from the contribution of the bond portfolio, taking into account the sales in 2019, and whether you expect more in 2020, and if you think that this could be balanced with the creation of business that was weak in Q4. So could you please elaborate how you see credit or lending for 2020? And second question is, could you please give us updated information regarding the capital return goals you need in order to achieve your goals, and what schedule we could expect? Thank you, Paco. Sorry, we're taking notes. Well, the contribution of bonds in 2020, as I was trying to explain in the presentation, is going to be lower compared to 2019 as a consequence of the fact that, first, we have less bonds that we used to have at the beginning of last year. We have 2.5 billion of amortizations this year, and we have to see if we're able to find assets in which we can reinvest, an asset without risk, sovereign debt. We're not going to work with higher risk assets, and basically we're speaking about Spanish sovereign debt. I guess there will be a bit of reinvestment, but the yields at which we have this reinvestment will be a bit lower compared to a back book, because we're not going to have extraordinary terms. So the contribution of our bond portfolio will be lower compared to 2019. I cannot give you a figure right now because it will depend on the reinvestments we will be able to do. And regarding lending, do you want to explain it, Pepe? This past quarter, regarding balance performance, was a bit lower compared to the previous quarters. I think that there's always some seasonality effect, more particularly in the mortgage portfolio, which was a bit below forecast regarding new mortgages. And for us, this is something we want to relaunch. In 2020, we're working in our plans regarding the performance of the mortgage portfolio this year. And some write-offs that were not expected in business lending, the corporate banking part, that have reduced our lending balance at the end of the year compared to September. Having said that, for next year we see an evolution of the corporate and retail portfolio compared to what we've seen before, around 3 billion in corporate and around 500-600 million in retail. And we think that the negative contribution of the mortgage portfolio, 3.3 billion this year, should be lower, around 2 billion. And the net of all this should give us a margin to increase our credit back book around 1.5 billion. That would be a goal for this year. And this is what we have in terms of credit increase. You've also mentioned a capital schedule or the performance we would need, I understand, in order to reach 2.5 billion of capital excess. Well, the numbers are quite simple here. Assuming the maintenance of a third dividend as the one paid out in 2018, 2019, and considering that today with 13.0% we have an excess of 800 million, we would need to generate 100 basis points of capital, more or less the ratio around 14% net of dividend payout at the end of this year. Is this possible? Well, we think so. As you know, here there are elements, some of them we can control them, or they're not so much. We think that we will have more information over the coming months regarding models, internal capital models, and this is the scenario we have ahead of us. Thank you very much. Next question. Next question from Fernando Gil from Barclays. Please ask your question. Good morning. Thank you for taking my question. Regarding provisions, the extraordinary amounts you've broken down for 2019 were 150 million that shouldn't be in 2020. I just wanted to confirm that. And second question, regarding mortgages, what's the trend you're seeing in pricing after publishing 1.5 as yield of the average mortgage portfolio this quarter? Thank you very much. Yes, 150 million is what we estimate that we've had as an extraordinary thing in 2019. Regarding the pricing of the mortgage portfolio, well, there's a difference between the initial price and the average yield of the portfolio, which is the figure a bit. The performance is a bit below 1%, but then to price is a different thing. The new mortgage portfolio is over the average performance the portfolio stock has. And the situation we have regarding the price of mortgages is what we've seen over the past years, I would say. The competition is high in order to get mortgages in the market, and spreads tend to be to adjust. We've seen some of our competitors with movements of prices downwards, then they correct the prices upwards. Our mortgage offering has not changed much in terms of price over the past year. This is the price policy we've maintained, and it's reasonably constant over the past quarters. I don't expect big changes in initial prices in our mortgage portfolio. And as always, if our competitors do something, well, they reduce slightly the prices downwards. I think the changes we can see compared to other quarters in which the front book figure in mortgages was around 1.6 come from the mix of fixed and floating that we've had each quarter. It's true that the fixed mix has been reduced a little bit and the price is reduced a little bit, but there's not huge change. Thank you, Fernando. Next question. Thank you. Next question comes from Carlos Cobo, Societe Generale. Please ask your question. Hello, thank you for your presentation. A couple of questions. I wanted to ask you about the speed of entries in NPL, what percentage of the credit book would that be in order to understand the stability you're mentioning in underlying provisions? Because at system level we've seen that it's being stabilized, even gross entries are increasing, and it could make us think, as José has said, that the cycle could be leading you to bigger provisions. And on the other hand, regarding expenses, it seems a bit high, the growth in expenses, considering the pressures in the P&L. And I would like to understand if that growth comes from inflation in salaries or whether these are projects that we're going to start to launch now. Thank you. Thank you very much. I'll start with the second question regarding the expenses, and then you can answer the first one. This increase of 2% in expenses, well, not many new things. We are in an environment in which basically we're impacted by the increase of wages. They're established in collective bargaining agreement that affect the industry as a whole, and the salary inflations, if you consider the bargaining, the wage increase and additional increase due to other factors related to the increase of salaries, around 2.5%, between 2.25 to 0.5% of an increase of salaries. And this goal we have, this initial scenario of a growth of 2% in expenses, is due to the growth of salaries. I usually say in private that we have a monetary policy that wants to increase the inflation goal in the Eurozone 2% to 2%. And I think that at least in Spain, in general terms, banks have an increase of expenses around 2% or over 2%. That would be the inflation goal of the ECB. And we have that part, the negative part due to the increase of expenses, and the negative part of negative interest rates that are there, that have come to stay for a while. Therefore, the answer is yes. The salary bargaining, which is established in the agreements. And regarding gross entries, as we said in our presentation on page 28, gross entries are reasonably stable, around 400 million per quarter, which is, if I'm not mistaken, 0.3% of the credit book. These gross entries in 2018 were higher, around 500, but we were recovering more, although the difference was not that big in net entries. But 60% approximately of our book are mortgages, and most of them are very old mortgages. Mortgages that date back from 2007, 8, 9. So mortgages that have survived this crisis, the 7 years of crisis. We rated them AAA. If they've survived the crisis, it's very complicated that they will become NPL. So the stability we're seeing in gross entries is quite clear. Right now we're around 400 million per quarter. Thank you very much. Next question. Thank you. Next question by Marta Sánchez, BOA. Please ask your question. Thank you very much. First question regarding fees and commissions. The guidance you've mentioned, you expect double-digit of growth in 2020 compared to 2019. What are the main drivers? Particularly how you explain the good performance you had in funds compared to the industry. You've grown faster. Was it extended the offer from Bankia to BMN? Do you think you can grow in net inflows at the same rate next year? And second question is regarding MPAs. I think you've said that you don't expect to have institutional sales. What's the net reduction goal for NPLs in 2020 and net reduction of foreclosed assets? It makes sense perhaps to use the excess of capital you have in order to clean the NPAs faster. Thank you very much, Marta. Regarding mutual funds and fees and commissions, they're partially related. And I think the good performance we've had in investment funds in 2019 is due to commercial discipline, to commercial strategy, and that's why we're happy, because we think that our network is highly focused on our customers and our business. It's true that, as you know, our percentage of mutual funds in our bank is still a bit below our competitors. We're coming from behind. In Bankia's network, we've grown a lot, and in the old network of BMN, the penetration of mutual funds was very low. And we're particularly happy about the fact that in BMN network, we have managed to go very quickly in the distribution of mutual funds with our customers. For 2020, we still see this good performance, because what we're doing here is moving our commercial positioning with our customers in order to increase cross-selling. Many of these customers, they have direct income deposits, and basically through our program called Por Ser Tú, fees and commission exception program, we're fostering new mutual funds. So this is going to fare well in 2020. We're going to foster the use of credit cards and, of course, the purchase of insurance products. That's why we think these three lines are going to grow well, and the performance of fees and commissions is going to be positive. Before we said that, in recurrent terms, our cruise speed is around 6%, and we think that this change in our price policy for 2020 should allow us to take an additional leap and position ourselves over the 2% increase in fees and commission. 2% growth. We think that next year we should be able to reduce around 5 million euro in our NPAs number, and organically, in a normal way. And with the ratios would be around 6% gross and 3% net of provisions. And that's the scenario, the initial scenario we have. So far, we're not considering any other issue. And as always, throughout the year, if we think that there's something that could make us go faster without having an impact on P&L, we could consider it. Thank you very much. Next question, please. Thank you. Next question from Álvaro Serrano, Morgan Stanley. Please ask your question. Good morning. About fees and commissions, and then capital distributions. About fees and commissions, you insist on the fact that this policy of non-fees and commissions had improved your net promoter score. This was an important part of your commercial policy. Could you please explain that price policy? How did it change? Are you charging for maintaining the accounts? It's a percentage of a deposit. Could you please explain this change in the price policy and why you are more or less comfortable with the fact that there won't be collateral effects in terms of position, and why do you trust that this is going to be feasible? And second question, could you please share with us your latest ideas on distribution of capital? You've said in the past that you're waiting for the approval of the model. Is there any update? Timings, maybe? Why is that necessary to wait for the model if you're already at 13%? NPL is quite controlled. And if there are no problems in the outlook, please remind me why you're waiting for the model, not distributing the capital. Thank you very much, Álvaro. I'll explain the part related to fees and commissions, and you can elaborate on capital. You were saying, well, the change in our price policy can have an impact on perception or a collateral effects. I would go back in the response. We are in an environment in which our competitors are hardening their price policy in terms of fees and commissions, and therefore this is the environment we have in this sector. We want to have the better offer without fees and commissions for our customers, our loyal customers, and we're still very simple. We want them to have their direct income deposited with us. We've added some additional requirements. I continue to use a credit card or having mutual funds over a certain amount of money or insurance, home or life insurance over a certain amount of money. It's all or. Therefore, we're changing some of the requirements in this sense, and we think that for many of our customers, it's going to be easy to be in this new environment of no fees and commissions, and therefore our offering will still compare well with our peers because they're all hardening the conditions, and sometimes it's the consumers are confused. And not just that, this will allow us to improve, to grow our revenues in fees and commissions next year. We are optimistic that this change in policy will achieve these two things. And regarding capital, nothing has changed since we talked before Christmas with you, the analysts, or in a road show on Q3 last year. Our commitment to distribute capital is something we maintain. We want to be clear on how we're going to finish in capital ratios. We and the regulator, that to material uncertainty. First of all, the RPH resolution. We have to see what happens. It should be reasonably soon. So nothing has changed since we talked in December. We're waiting for the resolution. And second, the approval of the models. This is a milestone that we think it's material. It should take place in the first part of this year. So there have been no changes compared to what we talked. The field work has finished, and we are waiting to receive, first of all, the draft report and then the final report that, as I was saying, we expect to receive over the coming months. Once we have closed these issues, you know that this year we have the stress test. We don't think there will be a problem there, and then we'll have a clearer picture of the capital situation of the group, and therefore we will be able to carry out or not the retribution policy. Next question, just one question so that we can have more analysts. Thank you very much. The next question comes from Dara King from KPW. Please ask your question. Good morning. I had a question regarding digital sales that you've mentioned. They have increased to 35%. Could you please give us an idea of the percentage in economic value of these sales? And in the midterm, I imagine that you expect that percentage to increase. What are the implications for the distribution and for the necessary investment in order to become a more digital platform? Thank you very much, Dara. In million euro economic value, I don't have the figures with me, but we can provide them to you through investor relations team. I think that the bottom line of your question is that digitalization is moving forward. This is a clear reality. And of course, in the mid and long term, this makes us think that the need of or how we will depend on our branch channel will be lower. Bankia in 2012 had 3,000 branches. BMN had 700 branches, so 3 1,700, and now we're around 2,000. So the branch channel is going to be less necessary. And we always see this as an opportunity. It should help us to reduce costs and to provide a better quality of service to our customer. Our customers want to have a remote relationship, a digital relationship with Bankia. And I think there's a positive side of it. And in the mid and long term, it will help us to reduce our costs, to be more cost efficient with our new digital customers. Thank you very much. Next question. Thank you. Next question from Ignacio Largui from Exane BNP Paribas. Good morning. A question related to your strategy that you announced last quarter in order to charge to big deposits and financial institutions. There's a guidance about 3 billion deposits a quarter. Could you please update the customers related to this strategy and the impact in 2020? Thank you very much. Ignacio, update the relation, that was what you said. Anyway, that as we've mentioned fees and commissions before, I think that regarding charges from deposit to certain customers, we're in the sector, the entities, they may be nuances, but over a certain size, we're all trying to pass on the negative costs we have of funds to our customers. And this has been accepted quite naturally. I think that as time goes by and this becomes a common practice in the sector, I think that this is being accepted in a natural way. Maybe in the short term, we'll see and we'll pay attention to it, some sort of transfer between credit and deposits by companies that maybe had an excess of cash and also credit debt positions. They were doing some netting between their positions that could have an impact in the short term to our credit balances, but in general lines we think everything's very normal. Regarding the impact in the P&L next year, do we have any figure, Leo? No, it's a mix. It's a mixture. The exit of deposits entails a lower liquidity and a lower liquidity cost, which you know how much it is, 0.50, and if companies decide to stay, part of them will have a charge in net interest income, and many of them will come through the line of fees and commissions. So it's going to be a mixture. We have some scenarios, but they depend on the flow movements, as Pepe has explained. So let's move on to the English line. Thank you. Next question from the English line. Dieter Smith from Autonomous. Please ask your question.
Yeah, hi there. One clarification and one question, please. On the fee growth guidance, double-digit fee growth, can I just confirm that you were guiding to underlying fee growth being 6% and the top-up coming from pricing policies? And then I would like to get your view on CRD5 as to whether you think that there's something that could be interesting for Bankia, and maybe you can comment a little bit on your issuance plans for 2020. Thank you.
Yes, Brita, the fees, what we say basically is that in 2019, there was an increase of fees and commissions once we removed the extraordinary things of 2018 around 8%, and the guide on the double digit we've given you, we think that we should be able to build it up because of the evolution of our fees in 2019 and assets under management, insurance, and performing credit as a consequence of our commercial policy that will make us reach this double digit we've mentioned. Regarding capital impact as a consequence of new regulations, we don't think that we're going to have an impact, a significant impact over the next years. Nothing in exercise in year 2020, nothing negative. As you know, the new impacts will start in 2021, 2022, if Basel III is applied, and as we explained in our breakfast, we're not expecting impacts, at least negative impacts. With the implementation of 02 and 05, we think that the net should be positive for us, and in Basel IV, the biggest uncertainty we can have is due to operational risk, because if we have an impact due to credit risk, it will be positive. And we have to add the 104 base, the possibility of building part of to our pillar through more issuances of tier 2, and which could lead us to have a release of 90 basis points in CET1. So therefore, over the next 2 to 3 years, we're not expecting any significant impact, at least not negative. Last question, please. Thank you. Last question comes from Sophie Ederson from JP Morgan. Please ask your question.
Yeah, hi. Here is Sophie from JP Morgan. I was wondering if you could just comment on kind of your view on M&A, how you think about it, how you think about M&A versus distributing excess capital to shareholders. And then just also a quick follow-up on IRPH. You mentioned that there will be something soon. Do you have any date or any additional details that you could share on the IRPH issue? Thank you.
Thank you very much. Regarding M&A and the excess of capital, I would say, well, we mentioned it when we launched a strategic plan. For us, the goal over these 3 years was not continuing carving out more transactions as the one we had with BMN. We wanted to use the excess of capital generated in order to give it back to the shareholders, and we still think the same thing. And in this sense, we're not considering anything, we're not analyzing anything or considering any transaction. There was something else, right? IRPH. We don't have any new thing. As you know, after the hearing in September with the General Council, we are waiting for the final judgment to be issued. 3 months have gone by since the hearing took place. We don't have inside information, but we expect that over the next months this ruling will be issued. Thank you very much for your interest. We would like to apologize to the analysts that couldn't answer questions. We have a busy agenda today in our IR team. We are at your disposal in order to provide you with the answers to your questions. We'll have follow-up with the rest. Thank you very much. The presentation of results for the first quarter will take place in April. Thank you very much.